Happy New Year 2026 and hi-ho silver.
Hi-yo silver!
Or more importantly, how high can silver go? Can silver repeat in 2026? It's outstanding. Incredible 145% gain that it saw in 2025. Well, time will tell. And speaking of 2026, it has started out with a bang, especially if you're in Venezuela, with President Trump's stunning raid on Maduro, seizing him and taking control of the country's oil assets, which are a game changer potentially for the U.S. going forward. It's truly going to be an incredible year and will probably be another incredible year for precious metals because the trends that we've seen that have driven gold up 64% in 2025, silver 145%, platinum 130%, and palladium 85% remain firmly in place in 2026. We may not see gains of those magnitudes, but we certainly will see further gains for precious metals as 2026 moves forward in time. Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. If we can help you with any of your needs in the physical precious metals arena, we'd love to have that opportunity. In this gold market commentary for Friday, January 9th, 2026, what we'd like to say is the trends that drove gold, silver to record highs in 2025 and platinum and palladium to record breakouts remain firmly in place. Those gains were driven and will continue to be driven by unusually large physical buying of precious metals across the board as the world makes a run on the precious metals market, or continues to, which is why when we get corrections, they'll tend to be short and shallow, and we're going through corrections right now, which create good buying opportunities. That's what we've seen so far. Because this market is not controlled by paper speculators. It's physical buying that's driving this. And when we get a price dip, more buying occurs. That's the telltale sign. And we're seeing it right now as we come out of a pretty volatile holiday period, which we'll discuss in this update. Remember, the trend is your friend, and the trend remains firmly in place for 2026 for precious metals. So let's get on with our update, and we're going to focus on silver because silver has had the most astounding last couple of months, and there's been a lot to talk about over just the last couple of weeks. First of all, the fundamentals for silver remain firmly in place. It is a critical U.S. mineral now. We've seen restrictions on Chinese exports of silver, restricted to just the 2 or 3 largest potential exporters there are in the nation, which virtually shuts down any casual exporting of silver that could occur out of China. And of course, China is a leading consumer of silver products as they are a leading manufacturer of solar panels and EVs. And while demand for physical silver will remain high, production of it is a byproduct of mining of other metals, which means the ability to ramp up the supply of silver will be very difficult indeed, which is why we have a structural physical deficit. The world is continuing to consume more silver on an annual basis for the 6th year in a row compared to what the mines can produce. And as I said, they won't be able to ramp up production easily or quickly. So that means the world will continue to eat into the available above ground supply of silver. And we're seeing some of the major supply chains become problematic, as we witnessed firsthand in October when the LBMA went into dysfunction because there was an overwhelming demand for physical silver at that point in time, primarily out of India. And that shows you just how sensitive the physical markets are at this point in time. And as I've said earlier, a couple of months ago, these metals have a kind of a hair trigger on them for supply and demand. And we're seeing that in earnest. And we've seen it in silver over the last couple of weeks with silver's astounding run going into the last couple of weeks of the year. One of the developments that I reported on in the fall of 2024 was the development of Samsung of an EV battery that's primarily made of silver that can charge in 9 minutes and go for 600 miles on a charge. Well, we're seeing that that is a real development in the silver marketplace because in October, Samsung went into partnership to buy and redevelop a closed silver mine in Mexico, the La Paria mine in Durango, Mexico. And that's a sign of the world trying to find as much silver as they can as fast as possible, with Samsung going directly to the source to try and find silver for the batteries that they need, which could revolutionize the EV battery market. That's one development that we're following. And I was one of the first to report on it. We're seeing record demand out of India in 2025, with India importing $9.4 billion worth of silver, up 44% from 2024. India doesn't produce much silver. They're going to continue to consume it. Indian investors can use silver for collateral against bank loans starting in April of this year now. That's going to continue to fuel record demand for silver in India. These things are continue to be very bullish for silver, which is why I'm mentioning them. And I think silver has prospects for big gains this year, but probably not quite as much as we saw last year. But I think $100 silver is going to be pretty easy to see, and maybe even $125 silver this year from here at around $80 an ounce right now. Let's get into our charts. Here's a 1-year silver chart. And you can see the moonshot that silver has been in once it broke $57 an ounce in late November. It's rocketed all the way up to a closing market high of 81.23. It's been in very choppy trading the last couple of weeks, which we'll drill down on in just a second, but it's settling into a pretty good range above 75 after some knee-jerk moves at the very end of the year. Let's drill down a little bit further. On a 6-month candlestick chart, you can see once silver hit that all-time high intraday of 83.62, it took a big tumble. That's when margin hikes occurred, both at the Shanghai Gold Exchange and at the COMEX Exchange right after Christmas. And that helped to break the silver rally for the short term. In fact, we've seen 4 margin hikes, again, the COMEX Exchange alone, since December 12th. We'll talk about those a bit more in just a second. But they've helped to hold the price in check in the short term. But we're seeing silver firming back up in just the last couple of trading sessions after taking another COMEX margin hit on January 6th. So this market's looking very resilient, and a move over 83.5 in earnest will signal a new breakout. And that will help probably to propel silver towards $100 an ounce the way this market has been moving, as fear of missing out has ramped up a lot in just the last couple of weeks because of silver's moonshot move once it got over $57 an ounce in the last month and a half. Now, speaking of margin hikes, silver made a big move higher when the market was very thinly traded, moving from about $72 all the way to $82 an ounce December 24th, 25th, and especially on Friday, December 26th. And then the market closed until it was due to reopen in China on the evening of the 29th. And that's when the Shanghai Gold Exchange instituted a margin hike, with the CME coming in right behind them on Monday, December 29th, which made a lot of people who were very bullish silver and had the weekend to think about $82 silver say that the Grinch stole their rally. Well, I've just done an in-depth second video that'll be available in a day or two that explains the rationale and the reasoning behind these margin hikes. And it's so the exchange can run a responsible exchange. That's really what it's all about. I'm not going to dwell on it here, but if you've been misled into thinking that these margin hikes are a way to punish the little guy in favor of the big bullion houses, you're being misled. And my video that explains the margin hikes in depth will shed a lot of light onto a subject that's been very misunderstood over the last couple of weeks, as emotions have been running high as the silver price ran high, and then these margin hikes came in. So our aim to give you the truth and the facts so you can make intelligent, reasonable, rational decisions and not emotional ones. Looking at a candlestick chart that's just 3 months for silver, you can see how silver was moving higher pretty steadily, and then the COMEX raised margins on December 12th for the first time. Then silver went into that rip-snorting rally the day after Christmas when the market was remarkably thin, peaking at 83.62, only to, on the reopen in Asia on that Sunday night, only to get creamed once the Shanghai Exchange raised rates and then the COMEX raised rates, basically in the same trading session. That's that big red candle. Then the COMEX raised margins again, and they've raised them now for a fourth time in less than 30 days, from about 16,000 to 32,000 per 5,000 ounce contract. So while the margins have doubled, you've got to remember that the price of silver has almost doubled during the same time as well, going back to when the margin was 15,000 back in September and October. Right? So as the price of silver has doubled, the margins have doubled as well, which keeps them at about the same percentage amount per the dollar value of the contracts. And as I said, my next video will explain this in depth if you really want to drill down on it. But that's really the rationale for the margin hikes, to run a responsible exchange that has enough cushion in the trading accounts to cover higher values and higher volatility. But this fear of missing out on this massive silver run has created a physical squeeze here in the US, and it is on in full now. We've seen physical buying surge dramatically, especially with the holiday gains that we saw for silver, which has led to a big buying wave. And the sovereign mints and the US Mint were already behind in changing over from 2025 to 26 this year. They've been lackadaisical about their changeover. And now we've got a surge in demand that's coming on top of some tariff uncertainty and the swap over from 2025 to 26 dates. But more importantly, the mints have been pretty much closed for the past 2 weeks leading into the opening of 2026. So they've been unprepared to meet this demand surge, and it's going to take the mints around the world some time to play catch up. And that's why the squeeze that we're in right now, where we're seeing a real lack of availability of sovereign minted products and higher premiums, is going to continue for the next few weeks at a minimum. But it will ease because these mints are in the business of making these ounces of silver for a profit. And they're not going to ignore the fact that there's a big demand surge here, but it's going to take some time to get the supplies to come into the marketplace to equal the demand that we're seeing now. So please be patient, but I wouldn't wait out lower premiums because the silver price could rise further and mitigate any premium reduction that you're looking for. So our job in the marketplace is to help you find the best value, and we're very good at that. And we've been through these squeezes before, during the great financial crisis, and especially during COVID when it was red hot. We had two big squeezes during the COVID years of 22, 23, 24, and we handled them all exceedingly well. We're now selling sovereign minted silver products for forward delivery, meaning we'll price them today and commit to the price today, but we may not be able to deliver them for 2, 3, or 4 weeks. And we've been in this situation before, and we've never not made a delivery, and we've never not honored a price. We don't intend to do so now. But the inventory chains have pretty much been cleaned out across the nation as the fear of missing out has ramped up. Now, the good news is that the squeeze that we're in right now is not nearly as severe as the squeeze we saw during the great financial crisis and during COVID. So I do think it will ease and won't be as extreme as we've seen in the past, but it's going to, again, to take some time. And that's contingent upon demand not ramping up too much more than it already is, while the mints around the world and the refineries around the world have a chance to increase their supplies, which will happen. So please bear with us and understand the situation that we're in, and we will take good care of you if you give us that opportunity. Speaking of silver supplies, this is how much silver is in the COMEX warehouses now. We hit a peak in October at 531 million ounces, and now we're down to about 442 million ounces. So about 90 million ounces has migrated out of the COMEX exchange since the peak in October, when the U.S. declared that silver would be a strategic mineral, but we still haven't got true clarification over tariffs. I don't think we're going to get silver tariffs. Gold is not tariffed. But we are seeing a migration out, and that's to help ease the shortages that we've seen in London at the LBMA and in India as well. So the COMEX still holds about double what it would normally hold in normal market conditions. So there's still a lot of silver in New York in the COMEX warehouses. Moving on to gold. Gold has had a big run higher in the last couple of months with, again, some choppiness as we peaked and then went into correction in November after October peak. And now we've hit a new high for gold just a couple weeks ago at 45.31, and we're firming up. The trend line is looking very good for gold. Drilling down on the 6-month candlestick chart, you can see the trend line, which is in blue, remains moving higher. We had a margin increase for gold, which is why we got that drawdown from 45.50 intraday. But now the market has absorbed that, like it has absorbed the silver margin increases. And we're moving higher as a result. So I think gold is looking very bullish. I think the prospects for gold to hit $5,000 are very good, and perhaps even $5,500 this year. I think the prospects for silver to break 100 are probably pretty good, maybe as high as $125 an ounce this year. These markets remain in extreme demand globally. And again, these are physically driven markets. Will help to buoy them further as time passes. I don't see anything changing. And with what's going on in the world geopolitically, the tension has been ratcheting up. We've had, President Trump has taken Maduro out of Venezuela. We're now looking to develop their oil fields to our advantage, which is giving the world a chance to take pause. We have some severe protests in Iran, which could destabilize Iran in the short term, which actually could be good in the longer term, but we could see some problems in the short term. We've had the U.S. sees 3 more tankers, or going after 3 more tankers just today of Venezuela and the Caribbean, which is a new development. We've got designs on Denmark, which the world is again saying what's going on. And of course, sadly, Vladimir Putin fired a hypersonic missile overnight into the Ukraine. And that conflict is going to continue to go on. So geopolitically, there's a lot of reasons why the world will continue to want to buy precious metals because of a lot of these new developments that are new to 2026, which didn't exist just even a couple weeks ago when the precious metals got red hot leading right into the Christmas holiday. That's another reason why I think the world will continue to underpin these markets and buy gold and silver and platinum and palladium too at record rates as we move further into 2026. With gold making a run higher, but silver making a big run higher, we've got the gold to silver ratio now collapsing down to 56.37 to 1, with gold at 45.10 and silver right at $80 as I tape this. It has gone past equilibrium. So silver is technically on the gold to silver ratio chart a bit more overvalued now at 56 to 1 relative to the equilibrium point that we've seen for years at 62.5 to 1. The ratio could go as low as 45 to 1 or 40 to 1 if silver continues to outpace gold, which could happen. It's very hard to say at this point in time, but silver has played catch up with a vengeance. As we said many times in early 2025, was possible when gold was running and silver was lagging. And now silver has played catch up, and to a huge degree. And we expect that silver's gains over the next several months or half a year will continue to outpace gold percentage wise, simply because we think it's easier for silver to attain close to a double from here at $80 an ounce, where it'll be more difficult for gold to double from about $4,500 an ounce, the way the pricing is shaping up and the way the world is consuming both of these metals. And looking at COMEX gold warehouse stocks, we peaked in April at 45 million ounces. We've seen a steadier move or slower move of gold out of the COMEX since that peak during the tariff turmoil time. Right now, COMEX gold warehouse inventories are down about 9 million ounces to 36 million ounces after the peak, and they've actually gone sideways to a little higher over the last month or so, which is interesting. So gold is pretty steady in the COMEX warehouse, while we're seeing silver migrate out at a higher and faster rate. Moving on to platinum and palladium. Platinum has made a moonshot higher from 17 and a quarter to 24.67 on New York close. We got in that corrective phase with higher margins for platinum as well on the COMEX. We've got support for platinum at 2055 with resistance at 2400. As we go to press, we're right at about 2275 today, so right in the middle of that range with the bias towards the upside. Looking on a 6-month candlestick chart, you can see we've had some real gyrations after that run sharply higher. We had a big correction on the 29th of December. That's when margin hikes for platinum went up as well. We had an intraday low of 1893 on that one candlestick wick that went way low, but it got bought right back up. So we see support for platinum at 2050 and resistance at about 2450 here. And right now we're right in the middle of that range. Any dips in platinum I would buy, especially close to 2050 if we get them, because platinum is a great jewelry substitute in Asia, Japan, and China for what has become more expensive gold. So we like platinum for that reason, and it's scarcer than gold. And so is palladium. And palladium's been on a more volatile ride higher. As you can see on the chart, it's made a big move higher now from 15 and a quarter to 2023 on the New York close, and a big correction down to 1613. But we're basing now at about 1750, 1775. As we go to press, palladium's about 1835. It's probably the most undervalued of the four precious metals. It's the scarcest of the four precious metals, but its industrial use is primarily in gasoline, automobile, catalytic converters, and it's not a good jewelry substitute for gold like platinum is. But fundamentally, it is the scarcest of the four precious metals, and it is the most undervalued of the four, I think, at this point in time. So we like palladium. Here's a 6-month candlestick chart. You can see we've got great support at 1600, intraday high at 2072, and we've been firming up over the last 4 or 5 trading sessions. Palladium's looking pretty good. I think it could easily get to 2,500 this year if the trend continues the way it's been going, with platinum perhaps testing 3,000 this year. That's a possibility. So time will tell. Moving on to U.S. economics, we've got an anomaly in the yield department for the 10-year Treasury yield, which has been rising over the last couple of months. That's what a lot of interest payments are determined by, the 10-year Treasury yield, while the 2-year Treasury yield has been falling. That's where the market thinks the federal funds rate will be. But investors are wanting more return, a higher yield for the risk that the longer duration Treasury offers. And that's what this divergence is about. And normally in a decreasing interest rate environment, you would see the 10-year Treasury yield coming down more than it has, or not rising, while the 2-year is falling. So we'll watch this as time passes. But this signals that maybe some problems for the U.S. refinancing treasuries in the future. The dollar index remains in the lower part of the range that it's been in for the last 4 or 5 months. It's right in the middle of the range right now, between 97 and a quarter and 150 on the index, after dropping about 10% since the beginning of last year. It's been in a bit of a rising trend over the last couple of trading sessions, but I don't see a lot of impetus for the dollar to break out sharply higher or sharply lower. I think we'll go sideways. So that won't make much impact on precious metals in the coming couple of weeks, I don't think. We'll see what happens. One of my friends who's a real estate syndicator posted this on his LinkedIn page, Keith Weinhold. Keith's a pretty sharp guy. And I just thought it was interesting that this explains in visual graphic the kind of us against them world that has developed in 2025 and will continue into 2026, which is why I wanted to show it. The US and the Western nations against the BRICS nations and the global South. Friendly countries are in blue. The not so friendly countries are in yellow. And then you've got problems in orange and especially in red. That's where US citizens are not advised to go. And this really graphically illustrates how the world has split. That's one of the reasons why precious metals have been in such demand in this past year, because the world is saying, hey, we want something other than the US and the dollar and treasuries. And they've gone to precious metals. And that's another big trend that'll stay in place. I did a wide-ranging interview a week or so ago with Ben Nadelstein of Monetary Metals. Put a link to it in the chat notes below if you want to see what my thoughts are on what drove precious metals to record highs in 2025. So you can hear for yourself, if you'd like to, why those trends remain in place in 2026, which is the rationale for higher prices this year still. Again, the link to that chat will be in below in the notes. And finally, that brings me to AI Guy, who has been popping up all over YouTube in the precious metals sector. He is a bot, and he is being trained on every precious metals pundit and pontificator out there. And if someone's delivering false or bad information, AI Guy is going to pick it up. He's prone to exaggerated claims that aren't, some of which are not based in reality. So please, we've had several clients ask about AI Guy, and we've dispelled everything that they've asked about. So please, if you see these videos, take them with a grain of salt, which is how you should deal with AI Guy. I had to mention it. If you're interested in getting started with precious metals and never have, we have a guide that explains the very basics, the most fundamental basics of the most widely traded, competitively priced, and for you, easily sellable modern bullion products, because that's really what it's all about, having something that the marketplace will take easily when you want to take profits. If we help our clients, we're helping ourselves in the long run. So that's why we've created this guide, to help you make the right decisions. Here's our website if we can help you. This is what it looks like with live, online, transparent pricing. Here's our YouTube channel. Please subscribe. And if you're moved, please like this video. Thank you for your support. And once again, here's our contact information. And as I've said, Happy New Year. 2026 is already off to a bang of a start, and it will be very interesting to see how all these new developments with the U.S., becoming more internationally driven towards resources and hemispheric protection in 2026 than we've ever seen before under President Trump. He's going to bring a lot of big changes this year. And we'll see how they pan out. But it's going to help the rest of the world want to continue to buy precious metals the way I see it, which will help to underpin and buoy these markets higher, which is why I think we'll continue to have gains for precious metals in 2026, but probably not quite the outsized gains we got last year. But last year's gains were just extraordinary. So congratulations. And it's still not too late to participate if you think you've missed the boat. If we can help you, please let us know. Thank you to our loyal clients as we enter into our 28th year in business. We could never have done this without you. And thanks for your time today.